Good morning. I'm Gord Long with GordonTLong.com. As part of our ongoing series on financial repression, I have Chris Casey of Windrock Wealth Management joining us this morning from Naperville, Illinois. Welcome, Chris.
Thank you for having me, Gordon.
I appreciate you joining us. I've read some of your work, and I'm quite excited to have you join us here this morning. Chris, maybe we could begin with you giving our listeners just a brief overview of some of the things you've been involved with, some of your background, so that they know what you're bringing to the table here.
Sure. I'm a managing director with Windrock Wealth Management since we started the company about 2.5 years ago. And I've been involved in economics. Well, I've been an adherent to the Austrian School of Economics for about 20 years now. And so here at Windrock, we write and publish quite a bit on economic subjects, mainly from a macroeconomic level and how it's going to impact people's finances.
We'll talk at the end where people can find out more information on some of your writings, because you have put out a lot of materials, primarily through the Mises Institute, that are worth our listeners having a look at. But Chris, we're here to talk about financial repression as part of our financial repression series, and specifically one of your articles. But maybe we can kick it off by what are your views on financial repression? What's it mean to you? What's involved in it? And what are your concerns with it?
Sure. And you're doing a great job of putting this word out there and discussing it, because frankly, that phrase, financial repression, is not discussed in the mainstream media virtually at all. And it's an old phrase. It comes back from 1973 when some Stanford economists came up with the concept and wrote about it. It received a little bit of publicity back in 2013 when Reinhardt and Rogoff wrote a paper for the IMF. But besides your publications, your videos, there's very little attention being paid to it. And I think financial repression can probably best be defined as government intervention in the financial markets, which is causing distortions not only in the financial markets, but throughout the economy. And you can primarily put those interventions into two different categories. On the one hand, we have direct intervention, and we're talking about whether it's regulation, it could be anything from antitrust, to banking regulations, to capital controls, exchange controls, etc. We're seeing that the world over right now in some economic basket cases like Greece or Argentina. And on the other hand, you have the much more subtle indirect effects. And this primarily takes the impact of, or the effect of, manipulating interest rates, so artificially lowering them and distorting the interest rate of the structure of interest rates. In addition to that, it's just price inflation itself. And that's something that hasn't been in the news enough lately because people perceive it as being subdued within the U.S. But in reality, I think we're in for quite a bit of danger on that front. And you look at any resource talking about financial repression, whether it's Reinhardt and Rogoff, whether it's the original 73 economists, whether it's your website, inflation is indeed a key component of it.
It without question, it's part of we've concluded there are four cornerstones of financial repression. And first is inflation targeting. Can you imagine that you really target certain levels of inflation if you're a consumer or a citizen? But it is, and we've always had inflation by the nature of our money supply, but it's targeted inflation. Let's use 2%. And therefore, with lower interest rates, having real negative interest rates, which some people don't understand. It's using regulatories to ring fence your options, and it's using what we call obfuscation. That is manipulation and the stretching of statistics. And it's not to say that this is some kind of conspiracy. We don't believe. We think it's good people trying to do the right thing, but have policies and assumptions that are ill-founded. And even they'll admit that quantitative easing is an experiment. We think personally it will turn out to be a massively failed experiment. Your views on that?
I completely agree with that. And the St. Louis Federal Reserve just had an economist that came out and said quantitative easing has had no impact upon the economy. So in large measure, even those actors that are doing these deeds recognize that. Now, with the possible exception, if you recall, Bernanke, because he was on record, I believe it was 60 Minutes, saying, well, we could turn this off and reverse it on the drop of a dime. So I agree with you as far as those categories. I agree that it's widespread. And I agree that the central bankers throughout the world are pursuing really misguided policies.
And time will tell. And, well, it's clear that it's failing. I mean, 6 years? And the best recovery we have in the world is apparently the U.S. economy, and it's the worst recovery we've ever had. But maybe the bigger issue is the distortions that it's brought in. lack of price discovery, mispricing of risk, malinvestment that goes with it. These are far more serious because they truly undermine the basic capitalist system where money is not savings disappear, it's not reinvested into productive assets, it's used for consumption. Now, you're of the Austrian school, I believe. Am I correct in those
That's correct.
comments?
Yes. I strongly adhere to the Austrian School of Economics. That's correct.
But am I correct in those statements I made in terms of the
degree absolutely. Of when you're talking about price discovery and artificial manipulation of prices, a lot of people forget the key price, perhaps for the economy as a whole, certainly for investors, certainly for businesses, is the interest rate. And not just one particular interest rate, but the structure of interest rates. And that's clearly being distorted over the years by U.S. central banks and central banks throughout the world through quantitative easing and other measures by which they're manipulating the money supply and thus distorting interest rates. So I completely agree. Price discovery is out the window, is how it's manipulated the various financial markets. And it's all due to what it's done to the interest rates.
Well, part of it is gets into some of the great work that you've done. And this whole concept of price. And then we get into, well, how do you influence? And we get into the Fisher equation, and which is a cornerstone of people's economic thinking. And it drives policy. And you point out that the whole concept of money velocity linked to the Fisher equation is flawed. Could you attempt to explain that simply for most of our listeners? Because it can get rather complex.
Sure. And everyone learns this in Economics 101, what's called the Fisher equation of exchange. It's named after Irving Fisher, who was one of the biggest proponents, although not originally a creator, who was actually Copernicus. And he really wrote about this, and it took off after 1911. And what it is an equation to attempt to explain the price level within the economy. And so on the one hand of the equation, you have M and V, the symbols, and that's the money supply and velocity, which I'll go into in just a moment. And the other equation, which it equates to, obviously, is prices and transactions. So the amount of money, the amount of times it circulates within the economy, so the velocity of money, those two multiplied together equal prices times transactions. And it's a very simple equation, but unfortunately has very dangerous effects because it's faulty. It seems like it makes sense, and it does. It's an accounting equation. It makes sense. Of course, the money that you spend on prices equals the prices. I mean, everyone understands that. But what's faulty is that there's no such thing as velocity. Take away this plug figure from this equation, and velocity seeks to have any meaning. I mean, how do you have velocity of money apart from velocity of goods and services? But more importantly, and I think what the Austrian School of Economics really brought to the table on this subject was a standpoint of, well, if you're looking at the price level within the economy, which, by the way, is very, very difficult to measure. I mean, it's a very difficult thing to attempt to measure. But if you are going to attempt to explain a price level and predict where it's going or ascertain where it's been, you need a theory of the price level. You need a theory of what's causing prices to go up and down. And lo and behold, every economist agrees that prices are influenced by supply and demand. Well, money is no different. Money is a good, just like any other good out there. It has different characteristics, but it's just the same impacted by supply and demand. When you have too much money, prices increase because the money's worthless. When you have more demand for money, that means prices are going down because people want to trade their goods and services for greater cash balances. And so what the Austrians said was, listen, the Fisher equation of exchange doesn't make any sense. It doesn't explain the price level. And if that's the case, then velocity has no impact whatsoever. In fact, it's a meaningless statistic. So maybe I would agree with the Fisher equation if he substituted V for D as in demand, but absent that, it really has no validity. And the real danger is that by looking at velocity, by being focused on velocity, mainstream economists have been focusing on a false measure, which creates false decisions, which is going to have a very real impact on investors.
When you look at price, part of that distortion when price times quantity is also there's a difference between price and demand, or price and value, I meant to say, and it's everybody kind of knows there can be a difference, and that can get greatly distorted if you're only looking at the price element. And that value gets into how much demand there is. And that demand is also a function of believing whether money is actually has a store of value. So if you're changing the money supply's ability to be a store of value, it shifts value and price gets greatly distorted. Does that make sense to you in your thinking?
I completely agree. I mean, all prices are merely a function of supply and demand, like I mentioned. When you have an artificial injection of money for any given price, whether it's the interest rates that it's affecting or some other price, it causes great distortions. And that's when you get the separation of price and value, as you're speaking of.
And this is really serious, because now all of a sudden your financial markets are no longer operating correctly, because you have the mispricing of risk, you have lack of price discovery, and you have malinvestment, which I believe we clearly have. And then your markets stop allocating money correctly. And in a capitalist system, it's about savings being put into investments that are generating real income. And what we have now is don't have savings. We're putting it into consumption in a 70% consumption economy, which is more debt servicing that goes with it. So what I'm trying to say is you actually fundamentally destroy the capitalist system if you protract this for any period of time, though it's not clear on the surface. Am I overstating that?
I don't think so at all. And we see that right now with companies themselves in the stock market. I mean, look over the last 10 years, the amount of money they have used on share buybacks or what have you is staggering relative to the amount of money that's actually gone into some type of productive capital expenditure. So we see that distortion right there with companies. You see it with individuals, you see it with governments across the board. All economic actors are impacted when interest rates no longer reflect the supply and demand of savings in the economy.
But 95% of last quarter's S&P earnings go back into dividends and buybacks, which are not going back into capital investment. You've got a death spiral on your hands, because that's not going to create employment and growth that's going to be able to sustain debt payments. So it's self-fulfilling and self-fulfilling. So the policies themselves are creating a destructive vortex or cycle potentially.
Well, I completely agree. And given that lack of investment and given the debt burdens that are being taken on, you're never going to be able to grow, whether you're looking at a company or a government, out of these debt burdens. So while it's at unsustainable levels as far as solvency right now, it certainly will be at unsustainable levels at some point in the future as far as liquidity. Because once interest rates reflect their true nature, meaning reflect the natural rate of interest or what reflecting the supply and demand for savings within a society, that's when we see these misallocations going to bear some fruit and have to be liquidated. And unfortunately, we could have had that in the aftermath of 2008, but the government stepped in and did everything that they should not do. So you had massive deficit spending, you had massive increases in the money supply, and perhaps just as dangerous, you had massive bailouts, because the first thing that any central bank should do when confronted with a recession is the exact opposite of what the U.S. government did in the aftermath of 2008.
Precisely. Chris, you're in the wealth management. You're in consulting and advice. What could you suggest to our listeners that they should be doing or thinking about to protect themselves in this environment?
Sure. Well, let me lay that out in a couple different scenarios. On the one hand, what do you do personally? What are you doing for your own just basic balance sheet? And I think it behooves everyone to look at getting liquid and paying down debt for what we're in store for. Now, having said that, the next question is, well, how do you profit from what may come down the pike here? And I think there's a couple different ways depending on how the economic situation develops. On the one hand, it may play out where we have some kind of massive recession and some kind of brief deflationary episode in which the Federal Reserve and central banks around the world come out and massively increase the money supply once again. So they'll have a different name than QE because it will sound ridiculous at that point. But once they start increasing the money supply again, I think that's when inflation may really take off. So we may see a situation where people are whipsawed from a slight, brief deflationary episode to massive inflation. The other hand is that things may get away from them altogether. And I think this is somewhat of a less likely scenario. And you may have inflation right off the bat. But either way, what individuals should be doing right now to profit from those scenarios is building kind of a portfolio of hard assets. So you want to look at anything from precious metals to certain types of real estate, like rental real estate, like farmland. You certainly want to look at potentially foreign currencies to diversify from the U.S. dollar, despite the dollar's strength over the last year. And so, regardless as to how the economic scenario plays out, whether it's sequential with these different episodes, the end game eventually will be a massive, I think, inflationary recession. So think of either the Great Recession with inflation, or think of the 1970s, but far, far worse.
Either scenario, not that attractive, but it does say you need to start preparing for whatever is inevitable here. And it is inflation or hyperinflation, and where I define hyperinflation as a currency event, and that is when you debase the currencies the way we are, at some point people lose trust in the currencies, and therefore you get hyperinflation at that point in time.
Certainly. I don't know if we'll necessarily see hyperinflation in the U.S. We could if things get bad enough, but you're right. That becomes a demand effect, really. And so going back to the price level, which is talking about changes in the price level when we refer to inflation, if the price level is determined by the supply and demand for money, then initially, if you have a significant increase in the supply and you see an increase in prices, at some point, individuals lose faith in the currency, lose a demand for that currency, and are willing to really get rid of it for anything. So in Venezuela right now, they're buying electronic goods. In Argentina, I'm sure they're buying similar things. But anything that could retain its store of value in critical times.
If you go around the world, most of the countries, you mentioned a couple, but you will see, and if you go back to the Weimar Republic, it's because the currency debasement is such that you look for a store of value that will protect yourself, and gets into goods, stocks start to appreciate. And we're clearly seeing that on many fronts around the world. And you make a good point whether it'll come to the United States. My personal opinion, as bad as the U.S. dollar may be, it probably will be the last to fall, being the least ugly of the scenario. But make no doubt about it, our deficits are larger than almost anybody else's in the world, and are unpayable and indistinguishable at this point. If you believe people's work like Lawrence Koutlakoff that suggests the fiscal gap is $210 trillion.
Oh, I agree. The U.S. Debt situation is certainly out of control. And what makes the U.S. especially vulnerable down the road, but I agree with you, you hear all these different analogies as the cleanest dirty shirt in the closet, what have you. I agree with that. But also the U.S. is in a unique position, given its being the economic powerhouse for the last 100 years, given that its currency is the only one that's really a true reserve currency throughout the world. The U.S. has a position where their fall will be greater because the perception and the reality, there's a greater disconnect perhaps than any other country in the world is right here in the U.S.
Well, this is the worst case scenarios we're talking about, and probably high probabilities of these things unfolding on the current roadmap that we're on. What could leadership be doing to reverse this? Are we so far gone that we can't, or is this just politically impossible?
That's a great question. Let me break that down into both those categories. What could they do? It's a pretty simple formula. It's restoring a sound currency. It's backing into precious metals. Even better would be getting out of the currency business whatsoever, wholesale, and saying, well, let the free market decide what constitutes money. So they certainly have the means at their disposal to do something in theoretical terms. Then the question becomes, well, what practically can be done? And I think we're at a point now with the way the political scene in the U.S., where I don't think it can be fixed. Even if we had, everyone talks about Paul Volcker from the late 1970s arresting this inflation, which all he's basically doing is stopping what they're doing already, right? Because the Federal Reserve is the only one that can cause inflation. It's kind of like I've always thought that we should make every economist out there take the Hippocratic Oath, right? First, do no harm. So stop doing the problem, and you'll see some good things develop. From a practical standpoint, though, political standpoint, I don't think there's anything the U.S. can do. In fact, I think they're going to do the exact opposite of what they should do the next time we have a serious economic downturn.
It is solvable, but it starts with believing that you need sound money. And you need to have an economy that produces more than it consumes. We have neither. And when you build an an economy on those two cornerstones, it's impossible. And Paul Volcker, I lived through that and refinanced a mortgage at close to 20%. And it was minor debt issues and minor issues of inflation, though we thought they were high at the time. And it brought us to our knees. I can't comprehend what trying to tackle that problem would do today in a fragile global economy on a fiat currency based system.
Oh, it certainly would be far worse. And if the 70s are somewhat comical in that regard. You'll remember the whip inflation now pins that during the Ford administration, or could have been even before that. And we're talking about inflation before the middle of the 1970s. That was maybe 3, 4, 5%. It wasn't all that bad, I believe, until 1974 when it hit 9 and then 12, 13. And so not only did you have issues like that, but there were real accounting issues. And so I'm a CPA. It was my first job out of school acting as an accountant. And I remember having to study numerous accounting proposals that were in the 70s in place because a sound currency is a fundamental to any accounting system. And so rip that out and suddenly you don't know how well you did. You're back to bartering, right? Well, we started off with 8 chickens and ended with 2 pigs. And do we make a profit last year on the farm? I don't know. Same thing happens with businesses. If you do away with a sound currency, everything's misstated. Inventory, cash, you don't know how you're doing in real terms.
Where's this leading logically over the next 12 months? What kinds of actions are you anticipating?
I really think we're headed sooner rather than later for a recession. If you look at a number of different factors, we have a situation where it's been quite a long time since the last recession. So that's one factor. You start looking at different factors besides GDP. If you look at, you may have heard of or had Mark Skousen on your show regarding gross outlays. If you look at other economic variables, we're starting to see a downturn. And I think we're seeing that in the stock market. These companies have sales that are at best flat, declining at best flat earnings. And so we're starting to see that throughout the economy. If this does indeed happen, I think the Federal Reserve goes right back to their playbook. They start taking actions that they should have never taken in the first place, but this time it will be far worse. And so the results, it may not be like 2010 and 11 and 12 where you have a stock market going up and everything seems like it's doing okay. We just may have inflation with poor economic situation.
All indicators are right now that we may be in for a serious push on deflation. And where I'm saying that is global commodity prices are signaling that. Baltic dry rates, I see the supply cutbacks right across the board. Look at China, looking at possibly devaluing their currency further, which is deflation. What's happening in emerging markets. These are all exporting deflation in a big way. Is that a short-term possibility?
I think it's more of a symptom rather than a cause. I think what we're seeing is a lack of demand from these economies because there's a lack of real growth for commodities out there. And so in the Baltic Dry Index is an indicator of that as well. I'm not so much concerned about low prices somehow creating deflation because personally I don't think it does. And also I don't think deflation necessarily is a bad thing. In fact, it's probably good for an economy that's going through a recession. But I believe that indeed it's symptomatic of a great economic problem out there. And that's simply weak growth at best, if not declining growth throughout the world.
Yeah, very, very much so. I might take a slightly different view, Chris, and I'd like your view on it.
Sure.
On terms of growth, growth is anemic. But I don't know if it's a growth problem as much as it's an oversupply issue. And that is, when you have free money, cheap money, it does bring demand forward. That's the whole idea of trying to do stimulation. But what happens is it brings the demand forward, but supply ramps up remember your supply and demand curves, it ramps up very quickly to match it. The difference, though, on the supply side is cheap money will allow more players to get in. Price becomes the competitive advantage, or they use price, and pricing power disappears. And so suddenly oversupply in itself becomes a deflationary force unless companies start to go broke on that side of it. So anemic demand is one issue, But this cheap money itself has fostered this global oversupply, which you see in these emerging markets that have taken on close to $9 trillion of carry trade out of the U.S. dollar and are on the wrong side of that carry as they built out that supply.
Oh, I agree that there's what you would say is oversupply throughout the world. And perhaps what's even more devastating than too much supply is that you have the wrong type of supply. And so this is classic Austrian business cycle theory, where when you bring interest rates low, it causes businesses and other economic actors to make decisions they would not otherwise have made. And we see this right now, like you're talking about China or other countries. Businesses have entered into plans which will not prove profitable in the end. And so the only way to rid the system is to not have bailouts and let them liquidate and go under. But you're right. Supply, I guess I would say, it was front loaded, but it's also the wrong type of supply. It's malinvestment. It's investment not just in too much, but in the wrong things.
Precisely. And a way to prove that is, when was the last time you saw a large bankruptcy or any bankruptcies? That used to be a normal course of any given day or week bankruptcy. It don't happen anymore. And the reason is you just roll over the debt, you refinance it, call it artificial life support. You keep it going and you use price as a weapon, and oversupply becomes one of the ways of trying to get out from under it. Not conscious oversupply, but trying to capture market share. And if you add up all the market share, they come to 1,000%, not 100%. And something eventually gives. I'm not talking as an old manufacturing guy here.
Well, speaking of that, along those lines of thought, even when you have a bankruptcy, think about, the auto companies in the aftermath of 2008. Even when they go through the bankruptcy, they change the rules afterwards, right? Because I don't know if you remember where they came in, they said, well, you can't get rid of these dealerships. You can't properly liquidate and do things you should. We're going to give them a chance to come in and retain their property rights in that dealership contract. So even bankruptcy itself has been violated. It's another form of financial oppression.
These are all of the elements that are killing the capitalist system. And a stroke at a time, a rule at a time. And somehow we have to break free from it because we live in one of the greatest countries on the face of the earth. And there's so much potential here. If we could just unwind it somehow, but we keep tripping over ourselves, in my feeling, on a day-to-day basis.
Well, I agree. And I always kind of laugh to myself when I hear about economists saying, well, the U.S., the best we can hope for in a developed country like this is 2, 3, maybe 4% growth. That's completely incorrect. You could have tremendous growth, high single digits, maybe even greater, if we simply unburden the economy. And the greatest way to do that is by the 3 levers that government has to influence the economy, is to have them scale back what they're doing, right? So it's regulatory policy, fiscal policy, and monetary policy.
Yeah, right now we're trying to steer it with one lever called monetary policy.
Right.
And you can't steer a caterpillar with one lever. You need multiple levers. And where are they? They seem, government side of it, from regulatory and fiscal, seems to be absent, with one caveat. Regulatory seem to be misdirected through what I refer to as crony capitalist or regulatory arbitrage, which is a whole separate discussion. Okay, Chris, we're up against our hard line here. Great discussion. Any key messages you'd like to leave with our listeners?
I would tell them all that stay liquid, reduce debt, and start thinking about how to profit from the times ahead, because it will be like nothing we've ever seen before. So start thinking about some hard assets, build a portfolio in precious metals, rental real estate, farmland, and prepare yourself, because things can get pretty ugly.
Can you tell our listeners about Windrock Wealth Management and some of the specific things you're doing that address that? Sure.
I mean, it's one thing to say, well, you should be in precious metals, or you should be in rental real estate, you should be in farmland. That's getting the thesis right. It's another to find the right vehicle, the right partner to get in, or not only just to partner up with, but also how do you own it? Do you own, for instance, precious metals? Do you own the physical? Do you own the miners? What do you do? And so we help customers navigate that. We clients navigate that. We go out, we find the best partners to run farmland and lease it out. We find the same different partners to do it with rental real estate. And we find the right players with precious metals, and we try to do that throughout the portfolio. Those are just some examples.
We do the same thing at the Financial Repression Authority, Chris. Farmland, we agree. We look for players who are doing it, but we look at it in which countries are the farmland elements. Precious metals, agreeing with various allocations. We also look at it, but where do you store it internationally and where do you keep it, et cetera? How do you handle the taxes on that end of it, et cetera? Because those are a whole new range of regulatory issues associated with financial repression. So we're doing the same kinds of things, which is one of the reasons I was looking forward for talking to you. But you're down where the rubber meets the road. We're up at the conceptual levels, at our levels. But ours is a little easier than yours. You've got to go find the people that can really deliver. Ours is to make sure we're at least fishing in the right pond. You have to put the bait on the hook. Chris, we're going to have you back again. I really enjoyed it. Can you tell our listeners where they can find links to your writings?
Sure. The easiest way, all of our firm's content, whether it's videos or writings, what have you, is posted on our website from my partner and I. And you can find that at www.windrockwealth.com. It's probably the easiest way not only to learn about our philosophy, but also to get a hold of us.
Appreciate your time. Enjoyed it. And we'll talk to you again.
Thank you, Gordon.
Thank you very much. Bye.